simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Good afternoon, everybody. It's Master Trader Live. Dan's typing to me stuff. Welcome. Now, today we're going to divert a little bit from our normal with the technical analysis. Maybe a lot of information that, our goal here, Dan and I's goal, is always to dispel some of the beliefs that we are all inundated with, whether it's about technical analysis. In this case, it's about trading options, 10 fallacies that Dan has done. And so through that education, you can, I guess, advance from the maze of misinformation that's out there on the internet. Again, whether it's about a candlestick pattern or how to define whether stocks are extended to the upside or the downside, how all of this misinformation started. Well, the technical analysis part, I know. The options stuff, I think, is more or less, people just look at it from an overly complex way through statistics and Greeks and so on. So I think you're going to find this tremendously beneficial, if you're an option trader. And if you're not, it'll be a lot of education as well. So with no further ado, let's get started. Dan has put together a whole lot of information here. So let's get going.
All right, good afternoon. Yes, I love trading options. The Master Trader method, obviously, is everything starts with a bias of the underlying. So you still need to read charts. And then we go and we decide, and we teach that in our courses, do you want a directional trade or an income trade? And we'll get into that a little bit. But yeah, if everybody will put their drop down to all panelists and attendees. But there's just a ton of misleading market education, self-serving promotions in any industry, not just options, which we're going to be focusing on today, but in anything. It's just you've got misleading people out there trying to line their pockets, and they do it through various intentional and even in unintentional ways. But it gets said so much that then many people think that these are true beliefs. And that's what we're going to be focusing on today. And I just picked 10. I'm sure there's many more. We can address some of the other ones at the end. And the goal is to change your belief. We love using the word objective. And we're going to show you how you can make options line your pocket with profits instead of nonsense beliefs. But trading options, they offer incredible benefits if done properly. If done improperly, then it's a quicker way to lose money. So let's jump into this. The Master Trader method, of course. Here's the top 10 we're going to cover today. Only fools buy options. Only fools sell options. And you might be thinking, whoa, what else can you do? Well, we'll be explaining all that. When you sell options, there's idiots out there that I just saw an email 10 minutes ago. Some guy's doing a webinar today. Earn an extra 52 paychecks by selling options. It's profit as soon as you sell it. That is the biggest nonsense. Trading just by the Greeks is the best approach. What the heck does that mean? The probability of something happening is just to look at delta. Greg's going to have fun with that one because that is based on charts. And option quotes, don't look at charts. We'll show you that. Buying or selling short-term options. Some people say, oh my God, run for the doors. That is so risky. Well, not if done properly. Crossing the street is risky if you have your eyes closed and are walking into traffic. When volatility is high, you should sell both calls and puts. That's a quick way to blow up your account. if you don't use charts and understand options. Some people say, you know what, when you sell options, Greg, you'll love this one too.
Dan,
I have slides on every one of these, folks. This is just
Dan,
the table of
slow
contents.
1 second. I'm sure there's people in here that have no idea of some of the stuff you're talking about, but I know there's a lot of stuff to go through. But how do someone that doesn't use charts determine if volatility is high?
They look at the math, and the math will tell you if it's high based on historical volatility for that instrument.
I mean, we've seen some of these option services put on trades that they say it's because of high volatility, and we look at the chart and we scratch our head.
Right, because they aren't looking at charts. They're looking at the math, and they say, oh, but that's exactly what number 7 is implying that they do. They run their scans and they say, hey, these are all the high volatility options, so let's sell calls and puts on them both, because they're under the belief that options are overpriced, and just sell them. And as long as you have the stock doesn't move a lot, they're gonna net make more money.
I think my next question could lead us for the next half-hour conversation, so don't delve into it too deep. But a lot of the stuff that you go over, and for my whole career, so to speak, or becoming a professional at this, is to question, the accepted information and see if it makes sense. But how can math be wrong? Well, if they're using math to determine volatility, how could it be wrong?
Well, because math is based on the past, and it's just number crunching without any input of what the stock looked like. So that's what I want you to do today. Let's just jump right in here, because I want you to question the reasonableness of these beliefs, these fallacies. This is our approach. Master Trader Method, we always looking for a compelling pattern on multiple time frames. Then we decide, are we going to trade stock, trade options? If it is options, are we going to buy or sell them? Are we going to do a directional trade or income trade? That's all stuff we cover in our courses, and we'll show you a little of that today. Greg coined this term techno-fundamental analysis, where we look at market internals, intermarket analysis, and that just helps pinpoint amazing turns for our swing trading. That's our approach. I'll go through this fairly quick. This is just definitions for those that are not familiar with options, but real simple. People buy calls and they buy puts. What is a call? Well, it's just a contract that allows you to buy something and at a specific price on or before expiration. So it's a way to speculate on a bullish bias of anything that's optionable. So that's stocks, currencies, commodities, futures. The call seller is taking the other side of that bet, saying, I don't think that stock's going up, so I'll take your money and it's mine to keep as long as that call option expires worthless. We do both based upon the patterns. So when we buy options, we're profiting from a bullish bias with leverage, because these call options cost significantly less than buying the stock. And therefore, since our maximum loss is what we paid for it, we have much less liability, potential maximum loss, than buying the stock. Now, I'll show you when we sell options in a few moments. What about buying put options? Just the opposite. I look at something and I think it's going down based on the charts, and we teach you how to go to the option marketplace and buy the appropriate put option to match your bias, again, with leverage and limited liability. I'll show you the scenarios where we sell those put options in a few moments. Here we go, fallacy number 1. Only fools buy options because 85% of them expire worthless and time decay hurts. Well, time decay, when we, going back to this screen, whenever you buy an option, you have to pay money for it. And part of the value of the option that you're buying has this time decay component. So if the stock's not moving the way you want, or if you buy the wrong option, then that time decay will hurt you. We teach how to flip that on its head to make the time decay an additional benefit to buying options.
Got my
But I found this interesting study because I've heard this same statement in the past. Oh, don't buy options because you're going to lose all your money when they expire worthless. This CME study in 1999 said that that's a totally misleading statistic because it doesn't include contracts closed prior to expiration. It's just looking at the one. So if Greg and I are swing trading call options on shop like we did recently, then we're in it, a swing trade, we're out at a profit. That's not expiring worthless. We accomplished our objective. We speculated on a bullish position with limited risk and leverage. It was perfect.
How'd they come up with that statistic, Dan?
I don't know. I think it's just one of these fallacies that gets repeated over and over and over again, and then people think it's reality. But you know what, Greg? Even if it was reality, that still wouldn't bother me or you or us the way we teach for the reasons I just said. We teach you how to buy the proper in the money one where time decay is not hurting us. And we do that, as you know very well, by doing debit spreads. We buy one call, we sell an out of the money call, and we're still speculating on our bullish option position. But time decay is on our side. So even if that were a true statement, which based on the CME study, it's far from the truth,
I have a question.
What would stop us?
Dan's like a steamroller today. I have a question. The majority of options are not at the money. They're either at the money or give or take on either side of it, right? I mean,
of course. Look
right.
at open interest.
So all the other ones, now I'm asking a question, but it
Right.
seems to me that it would be a fact that all of the other ones would expire worthless.
It depends where the stock ended.
Well, that's what I'm saying, at the money. So if the stock where it ended is on the option table at the money.
Okay, if it ended at the money, then yes, you would look at open interest and you would see a huge number of open interest and out of the money options, and those would expire worthless if the stock went nowhere. So even assuming you're hypothetical, let's assume a bell curve of in the money and out of the monies, then that statistic should then be 50% expired worthless if the stock just went totally sideways.
But I'm not getting it, and I don't want to be here until 3 o'clock. I have an appointment later. But my point is, if whether the stock went up or down or sideways, at expiration, there's going to be an option strike that's at the money.
Of course.
So all the other ones, give or take, I don't know what amount of strikes above and below at the money, the majority of the other ones would expire worthless, wouldn't they?
The out of the money ones, absolutely.
Right. So, I mean, some option contra or the stocks, I mean, I've seen them where they have, I don't know, 20 or 30 different strikes that are expiring on a certain date. And so ones that'll expire the weeklies on Friday, the majority of them have to expire worthless, don't they?
It depends what the stock did. If the stock went up $1, they were out of the money a week ago, and now they're in the money, and they're not going to expire worthless. But let's just continue. And another reason is there's many different market participants here that they might want them to expire out of the money. What if we have a covered call? We want that further one to expire out of the money. So anyway, the point of this is we do buy options. Don't rely on this nonsense fallacy to prevent you from doing them properly, because done properly, they provide superior benefits.
So Dan, I'm sorry to interrupt you again, but point being, if we can determine direction, I mean, we don't know the time at which it's going to take to get there, but we know based on the chart pattern that something is either moving or getting ready to move. So our struggle, even as chart readers, is to determine how long is it going to take. So, you know, with that being said, you know, that's still the hurdle that we have to get over, because, you know, we can pick an option that is close to the money, but even if we pick something that's out of the money, you know, if we get the timing right, it's going to be in the money based on our chart analysis.
And we teach that.
Yeah.
Absolutely. We teach that because and it doesn't even have to become in the money, Greg, because we just need it to move in our direction, and the value of that call option is going up in value as the stock's moving up. And as soon as, you know, we manage our directional options pretty much identically as we do when we're trading stock. So if we get a nice, there was one ADT, I think we traded the other day, a beautiful 1, 2, 3, 4 breakout. And it just went up 6 days in a row, and we just trailed the stop. We would do the same thing with that call option. We would, as soon as it traded under a prior bar's low, we sell it and made our profit. And it's a swing trade using options. Only fools sell options because the potential risk dwarfs the potential gain. Well, when we sell options, and I have another screen here for you. Well, let me actually jump to this screen. Here's an example of selling options, a bull put credit spread. These are all beautiful candlestick patterns of master trader bullish setups. We'd look at multiple time frames, etc. But in simplicity, we say that's a beautiful bottom. And Greg teaches every one of these patterns in his swing trading course. So we sell a put under support. We buy a further out of the put, out of the money put. That's what's called a bull put credit spread. And that money is ours to keep as long as this stock or currency or commodity, whatever the heck it is, stays above that green line by expiration. So that's when we sell options. Let's go back to this. So why would we do that? Well, we're profiting in 2 out of 3 directions. If those were all bullish pictures, as I showed you, the stock can go up, it can chop around sideways, and it can even go against us all the way down to our break even, and then it's a profitable trade. So remember I said when people buy options, there's a time decay component. That time decay is like a melting ice cube where that's profit to us day by day. As the stock moves up and time goes sideways, we are making money. But then I get this second bullet here. I get this one all the time, even from you, Greg. Our maximum profit when we sell options is the amount of money you put in your pocket. Okay, I get that. What's my maximum loss? If I sell a $5, let's go to the third one right here, third bullet. If I'm selling a $5 wide put spread on Apple for 50 cents a share, and I just sell one contract, $50 is deposited into my brokerage account. What's my maximum loss? My maximum loss is if Apple closes at expiration below 195, then I've lost $450. So why on earth would I do this strategy? People ask. Here's the answer. We stop out of the position at the identical place as if we were trading the stock, which is under support. We wouldn't let this thing go $5 against us. And typically we have a stop out of twice the premium received. So with an 85% batting average times, it's like an insurance company or the casino, we're taking in premium over and over and over again, and we stop out of certain positions. If you are wanting to take Apple at $195 a share, because that, or $200 a share rather, because we're shorting the 200s, then the 50 cents a share that you took in has increased your cost, has lowered your cost basis to $199.50. So as you see Warren Buffett here, hedge funds do this. We teach people how to do it in our longer term trading. It's a great way to accumulate stock at a discount. These are our directional versus income trades. So when multiple time frames are in alignment, we buy options. When we just want to call a short-term bottom, like Greg says, you know, I don't know where you're going on the position, but you sure aren't going under support here. That's when we love selling these put spreads, and they're easy to find. We're more particular with the multiple time frame alignment when we're buying options. Nugget. I mean, this is, Greg and I believe this to a T, and we have more examples. Not using technical analysis when you're trading options is like driving a car blindfolded. It makes no sense to us.
I'm pretty amazed at, you know, the information that is out there about trading options, and most of it is based on statistics. And when I look at the charts and compare those statistics, I found it to be very interesting, the analysis of the history and how they come to conclusions that statistically the odds are in your favor with a particular strategy. And when you look at the recommendation and you look at the chart, you say it makes no sense whatsoever. So I don't know how they could ignore.
Well, because you and I believe in charts and they don't.
Well, I could tell you not to believe the sun's going to come up, but when you see it, how do you deny it?
That's good. Let's see. Linda, John, and even you, Greg, if you can put your drop down to all panelists and attendees. Fallacy number 3. When you sell options, the premium that you receive, like that 50 cents a share on Apple, so if you sold a 10 lot, that Apple example would be $500. There are some clowns out there who say that is 100% profit. And that's why I say, do you want to buy a bridge? You know, there's no gifts on Wall Street. So let's go through it. When we, and I define that on the other page, when we sell that put option, we're putting money in our account, and we have an obligation to buy that Apple stock at $200 a share on or before expiration. So that money that went into our account is not 100% profit. In fact, the moment you put it on, if you looked at your broker, your trading platform, it'll probably show a small loss, and that's because of the spread. You know, if you just sold it and had to buy it back in 2 seconds, because of the small amount of the spread. So your unrealized gain is 0. There is no profit until you have earned it. How do I earn it? You earn it over time. You earn it as the stock is going towards expiration and staying above the short strike price. You profit as Apple goes up in price, because then I can buy it back cheaper. If we're going to be talking about volatility, if we sell high volatility and then it contracts, we make money that way also. So this is what he wrote. This income is on demand, which means you can essentially write your own monthly paychecks. And I mentioned the email I got before the show started. He says, I'm going to teach you how to write yourself 52 paychecks this year. It's craziness. Don't believe that nonsense. We do it again. It's a fallacy. It's 1000% incorrect. But we do it like the stick figure. We say that chart isn't going down. We have a checklist of what we go through before we sell credit spreads, and we put it on and manage in between. Fallacy number 4. So this one's up your alley, Greg. I'll let you take this. Trading by the Greeks is the best because nobody can predict market direction. And I just quoted this. Tasty Trade is kind of one of the big ones out there who believe this, and this is what they quoted. Stocks are just standard normal variables, and there's no way to predict whether they'll go up or down. Greg, why don't you finish the slide?
I think it's an ostrich approach. I mean,
Okay, but why? Why is why? And so,
well, look, and maybe you could have that opinion if you never looked at a chart, but I can't believe that any service out there hasn't looked at a chart. So how can you deny that, let's just say, Apple is going up. You had a gap down the other day, but, the market went down, but how can you say that it wasn't going up or something isn't pulling back? So if you don't want to accept something as having potential truth, well, then you don't even look at it. But if you have that opinion, prove it to me. So, I mean, it's not part of our discussion here, but if I don't care who it would be that would have that opinion about you can't predict the direction, I would be very happy to have that discussion.
right. And, these other bullets here are, just some explanations of why technical analysis does work. It's showing the supply and demand and it's the collective supply and demand of all market participants at any moment in time. So it's real, it's objective. It's showing you higher highs, higher lows. It's showing you major support being tested over and over again. And the last bullet is your famous quote. The chart is a picture of psychology in motion, where people putting their money on the line, and technical analysis is we are trading those patterns. Fallacy number 5, and Greg, you're going to love this one too, so I'll let you take it on the next slide. Looking at the math, there's different ways that the term delta, what delta does, but these math folks say, look at a delta, and that's going to tell you the probability of something happening. If you short a 30 delta put, they are going to say that it has a 70% probability of expiring worthless, whether it's a call or a put. Not looking at the charts. So Greg, when you asked earlier, math is math. This is the part that is a better explanation to your question. They can pull up anything they want, spiders, Apple, IBM, whatever, and they can just go down whatever expiration and say, I'm going to sell a 30 delta put. They will tell you mathematically 70% chance it expires out of the money, profitable. And you and I say that's you can't make that textbook decision based on what the chart looks like.
Well, you know what, taking the other side of their argument, Dan, I would say if they had, and I don't care whether they did the trades or not, but if they could show me a track record of all of those recommendations and 70% of them were profitable, I would entertain what they said.
That, you know what, that would be an awesome study. Right. So the next slide, I'll let you do, Greg. So let's show them what a 30 delta call and put on a wide range igniting bar versus wide range ending bar, which is what we teach. So let's take the first one there on the left. Wide range igniting, it negated the bearish gap down. It's on support. You got the rising 20 and 50 MA. My question to you, Greg, is, do you think shorting an out of the money put or an out of the money call is going to have higher odds with that pattern?
put would be as close to a no-brainer as possible.
Okay, so elaborate, please, because
Well, I mean, you know, as you've pointed out to me, some of these services with their recommendations, and I pull up the chart and I look at it and I see exactly that picture. And they're selling some kind of bearish call spread on it. I'm like, how retarded is that?
they're going to get run over.
And they will, and I'll ask you, Dan, why? And you'll tell me something about high volatility.
Right.
So it's, you know, and if they were to just simply look at a chart or understand that picture, you know, I think the light bulb would go on.
I agree with you, and that's the ostrich approach. You have rocks in your head to put on bearish option strategies on this first wide range engulfing bar. That's a powerful setup that we teach. Let's go to the second one. This one's also a wide range igniting from consolidation after lower highs, 20 MA rolling over. Would you like to sell a put spread on that breakdown bar?
No, of course not.
No, it's the opposite of the other one. We would only be selling call spreads on the second one. So assuming mathematically that the odds of the 30 delta call and put on these two pictures it's ridiculous. Fallacy number 6. They say, don't ever buy short-term, don't ever trade, buy or sell short-term options. It's way too risky. Well, why is it too risky? And it is risky if you don't know what you're doing. Some believe that shorting, short expiring options, whether it's a couple hours, we in fact love selling options that expire on the same day. But we also have our weekly options trader. It totally focuses on selling these credit spreads that expire in 10 days or less. So the mathematicians out there say, they say, oh, that their sweet spot is 45 days because that gives them time to, you know, hopefully let things work out if the stock goes against you. But gamma simply measures how fast the stock is going against you or for you, and it rises the quicker as you get towards expiration. But we're chartists. We put, and I'll show you an example. We put on these trades based on the chart, and we manage them per the chart. So the gamma risk is irrelevant to us as a skilled technician. And I actually wrote a couple articles on these exact subjects. So I have them here if you want to look them up. So this one is selling these short-term options. And this next article was showing you how to buy options as swing trade and making, you know, structuring them to be giving you the better risk to reward than trading stock. This is an example of selling a bear call credit spread on the day of expiration. This is what we call a climactic sell setup, wide range bar, still in an uptrend. But let's look at this 15-minute chart. This was the opening bar, a bearish wide range bar, and all we were doing was calling a top for the day. So we sold the $350 call option. We bought the higher out of the money, the 360. We took in 48 cents a share. So I'll just use a 10 lot using math. $480 hit our account. As long as Boeing closes below 350 in a couple hours, we make 480 bucks. So the stock can go down, it can go sideways. And as you can see, I don't know exactly where we put it on in here, but the stock can even go a couple dollars against us and we still make money. So the theta, the time decay on day of expiration, just it's a melting ice cube. So we in our green trading room, we love doing these. And, you know, I showed you how to calculate the return on capital there, 5% return on capital. 2 hours later, we were already at 50% of our max gain. So we booked $240 and then moved the stop to break even. Fallacy number 7. When volatility is high, you should short both calls and puts. That's just craziness again. I'm going to show you VIX in a moment here, but here's our master trader tip. When we have sell-offs in the spiders, volatility is high, we are only selling put spreads on the spiders. And then we also teach people how to sell call spreads on volatility instruments. This is one of our favorite setups, and I'll show you right here. And this, I mentioned the techno fundamental approach and market internals. When these bottoms, these turning points are this year, folks. When all of these sell-offs and the spider, the S&P 500 ETF, this is what I live for. These are wonderful setups, and they only happen every 2 or 3 months when they line up so perfectly. So you get oversold spiders, volatility is ripping to the upside because of market fear, and then the market internals are at an oversold level that Greg teaches. They're in alignment. They give us the green light, which means go to the chart for your entry. So all these blue arrows, these are bullish turning points with oversold market internals. You only want to sell put spreads, not calls and put spreads. You're going to get run over on the call sides. So this is similar to that 30 delta example, but just in a different context. Fallacy number 8. Whenever volatility is low, and Greg, you asked earlier, what does that mean? How do you calculate that? Well, in TOS, there's something called implied volatility rank, and it goes to the option table. It looks at the current volatility, which you can read right in a column. It's called implied volatility in your quote screen. And then the implied volatility rank looks at that number. They say, what was the high and low of volatility over the last 1 year, trading, 252 days, whatever. And it ranks it from 0 to 100. People say, oh, over 50 is high volatility. Just, it's greater than 50%. Below it is lower volatility. And then you can graph it and you can look at a picture of it if it's hugging at the low line or the high line. But these people believe if volatility is low, don't ever sell options. Rather, you should buy volatility. So there's really 2 components to this fallacy. So let's address them one by one. The first one here is
option trades almost every single day, and the volatility has been low.
That's correct. That's why it's a fallacy. That's right. But I'll get to that one on the next slide. This slide, I just want to focus on buying volatility. I have a whole separate wonderful 4-hour course on trading volatility products, and they have the way they're priced based on VIX futures. They have these, what I call these vicious headwinds. And that's because they're having to roll the futures to give us this ETF product, the VXX, to trade. This is a monthly chart. Look at that. It was just $12,000 down to 31. I don't know what it is now. It doesn't matter. But I'm just showing you this because this is one of our favorite trades also, that whenever we get spider sell-offs like this, and we get our oversold market internals, and we get a bullish entry on the spiders, we sell out of the money credit spreads on volatility products. This was another old Wall Street axiom. When the VIX is low, it's time to go. And what that means is, hey, there's too much complacency in the markets. So it's time to buy volatility because it has nowhere to go but up. And that is another fallacy. Volatility can stay low longer than you think. And secondly, you can't buy the VIX, VIX. That's not a tradable instrument. That's just a calculation of S&P out of the money calls and puts, the implied volatility. This VXX, if you don't nail the entry on buying volatility, that is a fast way to blow up your account. Now, this is the second half of fallacy number 8. And Greg, this is what you were saying a moment ago. And this is the recent spiders until a day or two ago. So the blue stars, I say those are phenomenal times to sell put spreads because we're getting paid a whole lot more because volatility is high. So Greg, I'll let you look at these green arrows. I'm in green stars. Volatility is low, it's below 50. But my question to you, Greg, is would you have sold put spreads on many of these green stars, even though volatility is low?
Sure.
Sure. That's.
I'd look at the strikes and
Exactly.
I find patterns every day that I would consider doing it, but there isn't always premium there, in part because volatility is low. That's why we have to, do the factory work, as I call it. It's like if volatility was high, we'd be a lot easier.
Right. So that's this top bullet of mine over here. We sell volatility in all market environments, but we have our checklist that we go through. It has to be a compelling pattern. It has to be sufficient premium, which we have some rules of thumb, but I also, teach you how to do that more in the courses, and for the adequate number of days to expiration. So, every one of these green, we could talk about this very bullish move. And this last blue star was when the market internals were cooked, meaning oversold. And that's when we started, getting more aggressive, both in directional and income trades. So that's it. As long as it passes our checklist and we get good premium for however many days to expiration of calling a short-term bottom, absolutely we do it. Fallacy number 9. Greg, this one's right up your alley again. Master trader takes a stop. Look at, whenever we give a trade, it's the same format. We give the symbol, we give the compelling technical setup, we give a protective stop. What is a stop? And Greg, I remember you and I 20 years ago, we came up with these words. So this is our handmade definition. Well, what's a stop loss? It's the predetermined line in the sand where we're determining ahead of time that the reasons for entering the trade, they no longer exist. The pattern failed. So we exit the trade to preserve our capital and our mind. I think I added that part. Mm-hmm. So a stop loss, we teach people, it's like an insurance policy. It's not anything to be fearful of. We're 80-85% successful in our technical analysis reading and stock and option trades. We do stop out when things are not working.
Dan, I think you're saying that, and if I'm sitting in this webinar and I'd say like 85%, that's pretty good. Can you prove it? And we can, because I ran the statistics like a week ago in on our spreadsheet, and it came out to exactly 85%.
Awesome.
I mean, we have to capture that and actually show it.
And
we couldn't show every single trade, but I mean, there it is, how many longs and shorts and
to go back to you know, the belief that nobody can read direction and charts don't work, that would have to have an assumption that it's a coin flip. I don't care what chart you look at, it's a coin flip if it's going up or down. So that's 50% is a coin flip, right? So statistics 101, 85, you don't get 85%, and you and I have been at this 25 years, if it did not work. And, you know, so we don't need to convince anyone, but it works. So some people, they say, don't take a stop loss. They say because when you sell options, when you sell out of the money options, it's 100%, you know, time decay, extrinsic value. Just roll it. Just roll it in perpetuity, and you should be able to dig back your money over time. That's their belief. That is not our belief, and it's not true either. As the stock is going against you, you know, your delta exposure is hurting you. And then when you try to roll that losing position, so I roll this put spread and I go to my option quote, I'm like, hey, let me now roll it into next week or next month, whatever the case, you will find that you are having to pay money to do that you are not getting the benefit of additional time decay. So you're just making a problem worse. This is an actual trade we were in, and this beautifully illustrates it. We had a put spread on this pattern right here, on this little gap up day, right where the arrow is. We stopped out. We stopped out on this breakdown, a very small loss because we 1, 2, 3, 4, 5, 6, 7. It was on the 8th day. So we were actually making money through time decay over those 8 days. So that might even have been at a profit. I honestly don't remember. But the folks that would have rolled this, look, it went down to 140 bucks, over $40 against them. That's just crazy management.
Yeah, and what did you ever do with that picture that you had of the hay bale rolling down that was on fire?
Yeah, it's in the seminar still.
That's
right.
good.
Yeah, it's in the full option strategies course. All right, we're doing good on time. Here's number 10. The best way to make big money in trading options is to purchase far out of the money options. Greg, I think you had a story like this when you started trading OEX options, right?
Buying options is a poor man's game. Trying to make big money is a small investment. Well, it wasn't necessarily a small investment because I wasn't doing spreads. I was doing directional. And I guess it was certainly less money. You can't buy the OEX, but you know, I was buying 100, 200 contracts, which was pretty expensive at the time. The thing is, I didn't have any idea what I was doing. I mean, you know, so when this was, you know, 30 years ago. And
all right, so this fallacy is actually a little bit more specific. You know, we teach on directionals. I like 85 delta or higher because we're trading in the money options as a substitute for the stock. I want to get paid for our directional bias. Now, what this is referring to, and we do it, and we do teach it, but it's an exception. Like, remember we did one with Pat into earnings on, I forget what stock, but we bought an out of the money option for 25 cents, you know, betting on a big earnings move. But we did that intelligently. But novices who just say, hey, I want to pay a little bit of money and swing for the fences to try to you know, 10x my return on buying a cheap option, that's the ones we're saying it makes no sense. That's a stupid approach. The time decay in buying those out of the money options, unless that stock really moves in your favor, then that cheap option is just going to get cheaper and you're going to lose all your money. I like this quote from Dr. Alexander Elder. He says, people buy hope And that's that far out of the money option. So price that hope or fear when things are selling off and sell it to them at those inflated prices. And that's what we do. So we don't buy inflated out of the money options. That again is a poor man's game. Yeah, and I haven't been reading the questions, so I see Greg taking care of them. And if I've missed anything, feel free to email Greg or me anytime. So that's it. We went through our 10, and we can talk about if any of you have any other fallacies you want to talk about, or just questions, anything like that. But Greg's amazing swing trading course here, it has all these thought building modules. So at the end of the course, you know how to read all the messages on these charts. As Greg said, we weren't doing a lesson on a strategy or chart reading, anything like that today, even though we did show you a couple charts. So we didn't get into the beautifulness of those few charts that you would learn in Greg's swing trading course. But this is the foundation of all of our stock and option trading approach. Is show me the chart. I don't care if it's Apple. I don't care if it's a bag of rocks. We take our bias from that, and then we enter stock or option trades and manage in between. Greg calls it factory work. We do the same thing every single day. Pre-market, intraday.
The hardest part, Dan, is sitting on your hands, like this morning.
Yeah, no, exactly. This morning, yeah, exactly. In our bias yesterday, pre-market and at market open, yep, we're just grinding higher a little bit more for day trading, but swing trading setups stink.
By the way, that course on the end of day specials, you can get the there's no discount on that course. It's a steal at that price, but you can get the advanced money management course with it free.
All right, yeah, that's on these specials here. I have a full option strategies course where I teach you how to buy options, sell options, everything, 10 complete modules. This slide I'm just showing you, since I mentioned a couple times the credit spreads. We have more of a beginner course. Silver, gold is an amazing detailed 12 module course to show you how to sell these credit spreads for for the weekly income. And then the platinum offering has 3 months of our green trading room and the weekly options trader for a very marginal amount of money more. And we have these holiday specials going on now. You can go to mastertrader.com/holiday specials. Greg just gave you the link there, same link. And it's just amazing packages we put together that combine stocks and options and some other things depending on your interests. Greg, we have 5 minutes to go. If you want to take a look at the markets like always, or answer questions, or both.
Well, Ken's asking a good question here. I'm just typing to him. Does he mean for an options trade or for just buying the stock itself, the underlying? And he's saying, how do you I'm just reading it. How do you find the coupon gain for people who bought courses? I don't know, Nick, email me on that one.
Oh, yeah, no, I understand Ken's question. Yeah, Ken, the answer is you can look at Delta as a quick swag. He's asking me, hey, I'm entering an Apple put spread. I got a $2 stop. How do I know what my option's going to be if I stop out? And it's going to depend on when you stop out, because you're still making time decay. But a quick and dirty way, Ken, is just look at the option prices and then go $2 up. So let's say that Apple one for 50 cents. Look at the same spread, $2 higher, and see what the credit is. If it says 75 cents, then that's your answer. You'll stop out at 75 and have a 25-cent loss. But also, in our members area, I have a very detailed document on managing risk and explaining all of these option trades, and it has 3 videos in there, and one of them is dedicated to answering that exact question. You could look at a risk graph also, would show you. Greg, do you want to pull up your screens for a second, or should I pull mine up? Somebody's, let's see, someone's, Dima's asking about Roku hourly.
I can bring it up. Hold on. What I just dropped in there, that link, is trading the underlying, which pretty basic stuff, but most people have no idea of it. Share sizing and an idea of how many positions you want to put on in a day, and for an account, you know, which you can just pick the account size of your own and so on. So
And
hourly.
Yeah, yeah, when you're done with the hourly, Greg, go to the 15, because one of our subscribers in the green trading room textbook nailed a W bottom entry in it yesterday.
Oh, yes.
No, or 2 days ago. Look, I'm far left.
Here.
Look at that beautiful W bottom.
Yeah, no brainer.
Yep.
All right, so the hourly, it's kind of just a grinder to the upside. Kind of weird. I mean, this thing got, what was it? It got an upgrade, I think, here, and a downgrade over here. Or no, on the daily. Yeah, go to the daily. It got an upgrade, I think, here, and then over here it's gotten a downgrade. But yeah, the hourly, you know, it's been coming back, and got the downgrade and an upgrade. I think it got an upgrade this morning or yesterday. In any event, it's got this big nasty gap down, so I wouldn't do anything based on the hourly. You know, I mean, it's got a void, so.
But on the daily, I would sell a put spread for Friday if there was a juice, if there was sufficient premium.
Well, it's easy enough to see.
Because now it's above the red bar's high on the daily.
Well, you're not going to get anything way down there.
Right. This is going to be the problem.
So even if we went below yesterday's low of 136, just to call it 136, 137, you're not going to have anything for 2 days. And I can't even go down there. I have to add more strikes.
And then, right, so you either take it or not. You maybe do a higher strike price. Maybe you consider going out to next week, having 9 days to expiration. Those are all the considerations.
Right, so, look at the 136. That's got some juice, Dan, but the question is, will it not go down there by the end of next week? That's the rub with, you know, so with a pattern like this, I wouldn't be so sure, but 136 is pretty far away.
Yeah, it's just right. See, folks see Greg and I both, you know, because everything starts with a compelling pattern, and that's not we like compelling patterns that are more no-brainers. This one's just a bounce where it got shellacked 2 days ago.
Yeah, so I mean, if there was, you know, and sometimes you find those hidden gems or that gold, so you know, and you find stuff that has premium and it's going to expire in 2 days, and we look at that as like, that's a no-brainer. That's what we call a no-brainer. Can that go back down to 136 by Friday afternoon?
Right.
And one, the probability is no. Is it an absolute, you know, impossibility? Of course not. Right. You know, someone could downgrade it tomorrow, or you know, the market could crash. But look, as long as it doesn't gap down, you can manage the risk. The gap is the big risk with these spreads.
With anything, yeah.
Yeah, but you know, I mean, the risk to reward is skewed with credit spreads. But if you manage it properly, you know, like Dan does, 85% track record. So I give the same trades to someone else, and I bet you they could get killed.
Right. Right. Yeah. Particularly with that rolling fallacy.
Yeah. Yeah. So
All right. Well, I think
I just gave a trade to our ETF letter, Dan. I just was looking at some stuff while you were talking.
yeah, I saw
Look at that.
Telegram.
Look at, there's a wide range bar, breakout, igniting bar after a bottoming tail bar that took out those lows and sprung back.
Yeah, looks good.
You know, so you might be saying, well, what about that resistance over there? Well, this bottoming pattern and this continuation suggests to me it's going to keep going. So that kind of a pattern, and I don't know if this has any premium, Dan, but I mean, this is the kind of thing that we'd be saying, sell a spread down below that bottoming tail bar, and it would be a no-brainer.
Right, and we would have to probably go out 3-4 weeks to get any juice, but I'll look at it
like that
in a moment.
Right. So anyway, that's another wrap, Dan. Good stuff.
All right, hope everyone enjoyed that, and demystify those fallacies and use options to your favor done properly.
All right.
All right, good trading, everyone. See you next week. We'll be talking about retracement concepts.
Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.